Philippine shares inched up even as Q4 GDP slowed to 5.6% as expected, bringing full-year growth to 5.6% as well, below government's target range of 6 to 7%. For Wednesday, the PSE index added 0.4%, settling at 66.46, supported by $250 million in net foreign buying. It also notched a 3% gain for the month of January. Question now is, can the local bourse keep the momentum going through February? Let's ask our next guest, Carlo Lim, co-founder and CEO of DragonFi Securities, who joins us live. Carlo, good morning. Hi. Happy February.
Hi, Mimi. Happy February. Yeah, nice to see you again.
Good to see you. Good to see the markets still up 3% for this year so far. You know, when you look at interest rates, it seems like interest rates took the elevator going up, but they're taking the stairs on the way down. We already know that the Fed is not going to do anything, up until March. Same goes for the BSP. So I guess we're wondering, what do you see driving market movement for Philippine stocks in the next 2 to 3 months? I mean, even earnings, which gives you a snapshot of 3 months. What makes you confident?
Sure. Last we spoke, Mimi, I mentioned that investors are pretty much self-selected into two major camps. It's either you're a proponent of the immaculate disinflation narrative, wherein inflation continues to moderate while economic growth remains resilient, or you're convinced that the long and variable lags attributed to the 525 basis points worth of rate hike is finally going to take a toll on the economy. So at this point, it would seem that the US Fed has pulled off the improbable, with 6-month annualized core PCE at 1.9%. along with a quarter four US GDP at 3.3%. So this scenario argues in favor for a lower number of rate cuts, as you mentioned, the first of which is expected to happen in May, with an additional 2 towards the back half of the year. So consistent with what I've been saying, what I mentioned to you last December, this will put PSEI multiples in the first half of the year, followed by a more robust advance in half. So I actually sent over a few charts to demonstrate how this can unfold.
Go ahead.
So the first chart that you see.
Let's pull up that chart now. Go ahead, just explain. The chart will follow.
Okay. So the first chart that you see is from the Nasdaq from 2003 to early 2005. So 2003 was the first time I experienced a bull market, and you never really forget your first. The portion highlighted in blue represents the uptrend that ensued after the market bottom in late 2002. The uptrend was then terminated with the Nasdaq digesting its gains via a downward sloping channel, which it subsequently broke out from. All right, Mimi, were you guys able to display the chart? I don't see it from my end.
We're trying to follow it, but I'm not sure if the camera can catch this. But go ahead. We'll try to follow as we go along. We'll try to keep up. Go ahead. The second chart.
So the second chart is the Nasdaq from 2023 to the present day. So notice the striking resemblance with the first chart. It's just in a more congested manner. You have the uptrend that followed the bottoming formation, which was then terminated again by a channel that again was followed by a parabolic gains. So what happens next? So let's go to the third chart.
Okay, we're moving.
Yep. So in the third chart, you'll see that we're back again to the 2003 to 2005 period. And after the melt up following the channel break, the Nasdaq again consolidates its gains, this time with a falling wedge. So for the present period, we can expect some form of consolidation to occur. And so expect the US market to chop around a bit. For context, the 2005 version consolidated for around 5 months until May 2005. So the timeline works, especially given that there's a high probability that the Fed cuts in May. So this will be followed by an uptrend that will follow through into 2025. So what does this entail for the Philippine market? Can we display the last chart?
Go ahead.
Yep. So the final chart shows the PSEI moving constructively since its December 14 breakout of the downtrend, downward sloping trend line. So I expect the PACI to mirror the volatility that we will see in the US markets in the coming months, followed by a strong up move in the second half of the year. So something to note, today's market shows striking similarities to 1994 and 1995. So in 1994, the Fed actually doubled interest rates from 3% to 6%. And just like we did in 2023, everybody expected a recession, but a recession never came. So we had what we have today at the soft landing. So with inflation falling to 2%, the Fed started cutting rates 3 times beginning in July 1995. So again, if you look at the Fed funds future, the Fed expects to cut rates 3 times this year, again, beginning in May. So to this day, the S&P 500 1995 advance of 34% is the best gain going back to the 1950s. The second similarity with 1995 is during that time, another game-changing disruptive technology was being applied in a disinflationary environment. So the internet today, similarly, as I mentioned, 6-month annualized core PCE is now below 2%. And probably the biggest disruption in the past 50 years is occurring with generative AI. So in the last 11 rate cutting cycles since 1982, there are only 2 instances that the market was not up big 6 months after the first rate cut. That was in 2001, following the dot-com bust, and during the dot-com bust, and in 2007 during the Great Financial Recession. So I'm really very bullish going into the back half of this year, Mimi.
Clearly you're a believer that history repeats itself. You can find patterns in history.
Yep.
So in the meantime, you're a big believer, you're very bullish going to the second half of this year. So do you think that this first half is the time to accumulate, to just get in, buy? Is it time to be greedy?
Yes, exactly. So I would buy shares on the dips.
All right, buy shares on the dips. Going to another factor that's going to happen even before the first rate cut happens in the US or here would be earnings. We're starting to see the numbers come in. Thus far, not great. We saw Union Bank, it was down. Consumption industrial was pretty good. And of course, at the background, you've got inflation supposedly moderating and rates already at peak. What are you expecting to see in corporate earnings for this year? Because the earnings season is going to give us a picture of what happened in the late last year. But what about for this year? How will this year's earnings average compared to last year's?
So towards the back half of last year, of 2023, corporate earnings were expected to increase on a forward basis by 11 to 12%. But I think, given some level of economic deceleration domestically, I only expect corporate earnings to increase by around 8%. So that translates to earnings per share for the entire PSEI of 570.
That is for last year. What about for 2024?
Oh, no, for 2024.
For 2024, it's a modest growth of 8% from last year's 11 to 12.
Yep, that's correct. But the thing to realize, Mimi, is if you have depressed multiples, you don't really need a lot of earnings growth to really pick up the market.
Well, all right, that makes sense. These things are cheap for a reason.
Yep.
Here's my thing. I always remember the first time we had a conversation about the stock market. You talked about how the Philippine market is driven by a handful of just 6-7 stocks.
Yep.
Much like Wall Street's Magnificent Seven, that handful of blue chips. Do you still feel that way today, or are you more convinced that the movements will be, whether it's a rally or the other way around, will be more broad-based in this kind of environment?
So in this kind of environment, if you're only anticipating three rate cuts, it would still favor the larger capitalization stocks. So it would still favor the blue chips because, you're still going to make a distinction between those companies that are reliant on the cost of capital and those that can raise capital easily, which, lends itself to the blue chip stuff. So I still feel that there's going to be some level of concentration, especially with the PSEI.
All right. I think we're now ready for your blind item. Talk to us about the stock that you're monitoring closely. Don't tell us, just describe and leave our viewers to guess what this is. Before you give us your blind item, we're 7 minutes into trade for the day, and so far we're actually trading down. The PSE index is down by 0.1%, 12 points. We're at 66.35. Most of the subsectors are in the red. All shares also down by 0.1. Financials, industrials, holding companies, and property sub-indices are down in the dump. So more downward pressure. Services is the only one that's holding up. That sub-index up by 0.1%. So let's go over to your blind item. What do you have for us today?
Sure. This stock, I'm pretty high on. It has a dividend yield of around 7.3%. So the company has grown its dividends over the past 5 years at a CAGR of around 8%. The firm has embarked on an aggressive cost containment mode and shored up its balance sheet with asset sales. So its accounting woes are behind it, and it's baked into the price. Its forward PE based on consensus earnings estimate of 146 is around 8.74 with a 10-year PE average of 17.5. So I see 20% upside from this level 12 months out.
All right, 25% upside 12 months out. Sounds decent, sounds
20%,
good.
20%.
12 months out. Sounds good. On that note, John Carlo, always a pleasure speaking with you. Happy New Year again. We'll see you soon, hopefully, when the tides turn. All right. See you soon.
I appreciate it. Thank you. Bye-bye.